Hi everyone. Nearly $1 billion poured into SCHD during a single month. Either billionaires managing trillions are idiots, or they know something that you don't. Let me show you the data that explains everything. SCHD trades at a PE ratio of 15.6. The S&P 500, nearly 28. You're looking at a 44% discount for companies that have paid growing dividends through multiple recessions. The same week retail investors chase momentum stocks, institutional money adds hundreds of millions to dividend strategies. This isn't random, it's positioning. And if you understand what's happening, you can position alongside them instead of against them. The math that reveals everything. SCHD currently yields 3.8%. Most people see that number and move on. They want 8%, 10%, or something exciting. This is exactly why they stay broke. That 3.8% yield grows at nearly 10% annually. Do the math. Buy shares yielding 3.8% today, and in 5 years you're earning 6% on your original investment. 10 years, 10%. 15 years, 16% yield on cost. This is how wealthy investors think. They're not chasing high yields today. They're building high yields on their original capital over decades. Compare this to chasing a 10% yielder that cuts dividends during recessions. SCHD has increased payouts for 13 consecutive years. Show me your high-yield stock that matches that track record. The valuation discount is where smart money sees opportunity. When quality dividend-paying businesses trade at 44% discounts to the broader market, professionals recognize mispricing. When that discount exists while the market trades at historically elevated valuations, they recognize risk arbitrage. Why this opportunity exists? Markets obsess over growth stocks promising massive returns. That obsession creates the valuation gap. SCHD's holdings, companies making pharmaceuticals, energy consumer products, trade at massive discounts because everyone's distracted. Institutions understand obsessions end. Rotations happen, and the rotation from growth to value, speculation to cash flow, promises to profits, always occurs eventually. Look at the fund flows. Billions moving into dividend strategies while retail chases momentum. When retail figures it out, prices will be 30% higher, and they'll buy at the top. Again. Extremes in valuations always revert. Growth runs become value runs. The professionals positioning now understand this cycle intimately because they've profited from it repeatedly. The 3-level blueprint. Strategy depends on your capital and experience. Pick your level. Level 1, monthly automation. Invest a fixed amount monthly. Could be $200, $500, $2,000. The number matters less than consistency. At current prices, around $27 per share, $500 monthly buys roughly 18 shares. Enable automatic dividend reinvestment. Every dividend payment purchases additional shares. Those shares generate more dividends. This compound loop builds wealth while you sleep. With $500 monthly and 10% dividend growth, you're generating over $800 annually in passive income by year 10. Not from working harder, from letting mathematics work. No market timing required, no complex analysis needed, just consistent execution and patience while compound interest does the heavy lifting. This strategy works for beginners and billionaires alike. Level 2, lump sum acceleration. Deploy $10,000 to $25,000, but spread purchases across 3 to 6 months. This smooths volatility while establishing position quickly. $10,000 invested at 3.8% yield generates $380 annually immediately. Add dividend reinvestment and 10% dividend growth, and your income accelerates dramatically. Year 5 projects $500 to $600 in annual dividends, while principal appreciation adds capital growth. The combination of income plus growth compounds faster than most investors understand. Your initial $10,000 doesn't just sit static earning 3.8% forever. It becomes a growing income stream that increases purchasing power annually. This suits investors with available capital who want meaningful positions quickly without going all in at market peaks. Level 3, core plus concentration. Build a 3-tier portfolio. Allocate 40% to SCHD for diversified exposure to over 100 dividend-paying companies at minimal 0.06% fees. Add 30% concentrated positions in SCHD's top holdings. Companies like Merck, Bristol-Myers Squibb, Chevron, where you can research deeply and hold larger stakes. Final 30% goes to high-conviction dividend growers outside SCHD's portfolio. Realty Income at 5.8% yield, or Enterprise Products Partners at 6.8%, proven cash flow machines with decades of dividend increases. Portfolio yield hits 4.5% to 5.5% while maintaining growth potential. This strategy allows experienced investors to leverage SCHD's screening methodology while adding personal conviction plays. You benefit from institutional-grade diversification while maintaining control over concentrated positions. The institutional data. Here's what institutions see that retail investors miss. SCHD's expense ratio is 0.06%. For every $10,000 invested, you pay $6 annually. Compare this to actively managed funds charging 1% or $100 per $10,000. Over decades, that fee difference compounds into six figures. Portfolio quality. 85% of holdings have grown dividends for at least 10 consecutive years. These aren't companies hoping to pay dividends. They're companies with decade-plus proof. 3-year net flows total over $22 billion. That's not speculation money. That's conviction from professionals who've survived every market cycle. When you combine severe undervaluation versus the broader market, proven dividend growth, massive institutional positioning, and rock-bottom fees, you're looking at a setup that rarely appears. The institutional playbook isn't complicated. Buy quality at discounts, collect growing income, reinvest systematically, hold through volatility, repeat for decades. Why discipline destroys emotion? Financial influencers sell excitement. They want you to buy whatever generates clicks. High-yield stocks that crash, crypto promising 1,000%, options that expire, worthless. They make money from your clicks, not from you building wealth. Institutions make money being right over decades. They buy SCHD at 15.6 PE while the market trades at 28. They collect 3.8% yields that grow to 16% on cost. They reinvest dividends through crashes because they understand crashes create opportunities. The difference between investors who build generational wealth and those who stay broke isn't intelligence. It's discipline. The ability to buy when markets panic, the ability to reinvest dividends instead of spending them, the ability to ignore excitement and embrace mathematics. Emotional investing feels good temporarily but destroys wealth permanently. Disciplined investing feels boring temporarily but builds wealth permanently. Your implementation plan. This week, take 3 actions. Open a brokerage account offering commission-free ETF trading. Fidelity, Schwab, Vanguard, all qualify. Calculate your consistent investment amount. Be honest about what you can sustain monthly or quarterly. Consistency beats large, irregular investments. Execute your first purchase. Enable automatic dividend reinvestment. Set up recurring investments, then close the app. Stop checking prices daily. You're building an income machine that pays regardless of market direction. Daily price fluctuations are noise. Annual dividend growth and compounding are signal. The final truth. Billionaires are repositioning. The valuation gap between growth and value is historically extreme. Dividend stocks trade at discounts rarely seen. You can either position alongside institutions while prices are discounted, or wait until everyone figures it out and buy 30% higher. Your choice determines whether you profit from the rotation or you finance it. This isn't my advice. It's pattern recognition based on institutional behavior and mathematical reality. The question isn't whether rotations happen. History shows they always happen. The question is whether you're positioned before they do. Disclaimer, educational content only. Past performance doesn't guarantee future results. All investing carries risk, including principal loss. Consult qualified financial advisors before investment decisions. This is Invest ED, building wealth through dividend discipline. Smash that like button and subscribe for strategies that actually work. Investing smart, profitable investing.